Today, a lineup of stories that every car buyer, seller, and even dealers need to hear. First up, the middle class is getting priced out of the car market. I'll break down why affordability has collapsed and the insider strategies that you can use to beat it. Then a fresh market update. Used car prices are back over 30 grand on average. What's driving that jump and where car buyers can still find value. But it gets bigger. Some experts say we're in the largest used car bubble in U.S. history. The signs of that bubble bursting, they're already here. On top of that, dealerships are in turmoil. Car salesmen are quitting in droves. What's behind the mass exodus might surprise you. And finally, we tackle the biggest car repo crisis in U.S. history. It's exploding right now, and the numbers are staggering. Stick around, because what's bad for the industry could actually be good for smart buyers who know where to look. I too have seen the headlines saying that the middle class has been priced out of the car market. And honestly, I thought it was pure clickbait. But then I dug into the numbers, and I'll be honest, I was floored. This isn't just about prices creeping up. It's about a market shift so big that the middle class is getting squeezed out entirely. And here's the surprising part. What's bad for automakers right now could actually be very good for you if you know where to look and how to time it. So let's start with the numbers that made me sit up in the first place. The average new car price in America is now pushing $49,000, and that's not luxury anymore. That is the mainstream price. Want something affordable? Good luck. Only about 10% of new cars are under $30,000, the lowest share in decades. There's also ownership costs. Your payment, insurance, fuel, and maintenance are now averaging $12,300 a year. That's more than some families spend on food in 12 months. This isn't just sticker shock, it's a complete restructuring of what the middle class can realistically afford. And the irony, even with these high prices, dealers are sitting on slower moving inventory than we've seen in years in some segments, which means the perception that you can get a deal right now isn't always true. You just have to know where to find them. Then there's the tariff situation. New tariffs on imported vehicles and parts are expected to add about $3 grand up to $6,000 to the prices. Nissan has already hinted that their entry-level Versa could disappear completely. While the idea to bring more auto manufacturing back to the U.S. is helpful, that doesn't happen overnight. The costs are hitting now, long before any long-term benefits show up. That means if you are already feeling squeezed by higher car prices, I know you are, the next few years could get worse before they get better. And automakers know it, which is why some of them are starting to quietly prepare for heavier discounting. So how are the middle class buyers responding? Over half of shoppers delayed buying a car last year. Half. The ones buying are taking on record-breaking loans, monthly payments nearing $750 a month, and 7-year loan terms are becoming the norm, which is outrageous. More people are upside down on their loans for years, meaning they owe more than their car is worth, well into the car ownership experience. Naturally, some are looking at certified pre-owned or leasing, but even the used market hasn't reset to pre-pandemic levels. In fact, the average used car price is still hovering around 28 grand for a used car, which was the new car average about 5 or 6 years ago. Now, this is where it gets interesting for buyers because automakers are hurting too. Honda took a 50% profit hit in Q1, $1.6 billion gone in just 3 months. Ford saw profits fall 65% in Q1, netting just $471 million, and their EV division lost almost $1 billion in the same quarter. GM took a $1.1 billion tariff hit and saw profits for them drop 35%. Toyota projecting a 16% drop in profit this year, thanks to rising costs and a softening global market. When these companies start bleeding profits, it's only a matter of time before they get aggressive with incentives. It's basic business. They need to keep factories running and dealers happy. So yes, cars are expensive and the middle class is under pressure. But these financial headwinds for automakers could turn into your opportunity. If inventory keeps piling up and sales targets aren't met, manufacturers will start doing the following. They will offer cash rebates, good news for you, dropping interest rates, adding lease specials. They will quietly tell dealers to move products at lower margins. And this is where the smart buyers like you, the ones watching videos like this, will win because you'll know when to strike and what to target instead of getting caught in the panic of, I need a car right now, I'll pay whatever it takes. Don't worry, I got your game plan right here. Be patient, be ready. The best deals often hit when a model year changes over or a sales quarter ends. You can shop the slow sellers, cars that sit on lots for 200 plus days where you'll find the leverage. I do videos on those things all the time. Do your homework before you shop. Know the real market price before you talk to a dealer or visit their dealerships. Okay, I just read the latest numbers on the used car market for 2025, and honestly, I had to double check to make sure I wasn't reading this wrong. For the first time in years, the average price of a 3-year-old used car has blown past $30,000 again. And get this, the gap between new and used car prices have gotten so tight that in some cases, you might be better off buying new. But wait, there's more. There's always more. Tariffs are driving new car prices up. EV values are tanking and dealers are sitting on older inventory longer than they have in years. So what's really going on here? Is this used car market about to collapse? Are buyers about to get a break? Or is this just the new normal? Let's cut through the noise and break it all down. So the average 3-year-old used vehicle price, $30,522, up 2.3% from last year. It is up. This is the first time since 2022 that the average has cracked $30,000. The gap between new and used cars is now about $17,000, meaning used cars aren't always the cheaper value play that they used to be. And this is critical because for years, the default advice was buy used, save money. That's not always true anymore. If you're paying close to new car pricing, but missing out on the warranties, incentives, you've got to rethink your strategy. Get this, the average trade-in vehicle age, 7.6 years. That's the highest since 2019. Dealers are now keeping used cars for 38 days on average before they sell. That's the longest stretch since 2021. So why does this matter? Because if dealers don't have fresh, late model trade-ins, they can't feed the demand for those 2- and 3-year-old sweet spot used vehicles. That scarcity props prices up. Buyers looking for that nearly new car are basically fighting over a small pool. New car prices are climbing thanks to tariffs on imported vehicles and parts. Average new car is now pushing 50 grand. EVs closer to 62,000. That drives budget-conscious buyers straight into that used car market, spiking demand even higher. This is a double whammy. Tariffs aren't just hitting new cars. They're indirectly making used cars more expensive too. So the squeeze is on. It looks like used EVs are the outlier. Their prices have dropped thousands due to lower demand. Gas-powered cars are holding or climbing, while EVs may actually represent the only bargains in the market. This is one of the most fascinating parts of the market right now, if you ask me. If you're open to an EV, gotta be open to it, you could score a deal, but you've got to weigh that against the charging infrastructure as it sits now, battery health, and depreciation risk. Now, don't get me wrong, used cars are still a big market. 20.1 million expected in sales in 2025, up 1.2% year over year. Wholesale prices are dipping, but retail is slower to adjust, so there may be some relief on the horizon. But right now, the strategy is the following. Be flexible on the model and the year. Watch for used EV bargains, and don't assume that used equals cheaper. Run the numbers carefully first. So what's the bottom line here? The used car market in 2025 is expensive, competitive, and unpredictable. It's not the collapse that some headlines want you to believe on YouTube, but it's also not the buyer's paradise that we had hoped for. What do they mean when they say the market's in a bubble? It's that lingering hangover from pandemic era tightness, a record high pricing point with 3-year-old used vehicles averaging around $30,000, roughly 40% higher than before 2020. We're finally seeing some relief. Retail listings averaged 25.5 in August of 2025, down from the summer's high, but that's still well above pre-pandemic norms. Meanwhile, wholesale prices have dropped for 14 straight weeks, reflecting a slow deflation, not a crash. Tesla's used car values tell part of the unfolding story. For the first time ever, the average used Tesla sells for less than the general used car market of $27,800 versus $28,000. Every model, including the Cybertruck, is seeing value drops, some as steep as 30%. according to the New York Post. So yes, Tesla is a canary in the coal mine for EV resale corrections and is revealing cracks, not a full collapse. Here are some stats and sources. Industry forecasts from Cox Automotive, Car Gurus, and Edmunds point toward stabilization. Used sales volume is expected to tick up slightly. Cox projected 37.8 million used vehicles sold in 2025. Price corrections are expected to taper off, not implode. Still, segment-specific shifts matter. Compact cars and luxury sedans are correcting fastest. Pickups and SUVs are remaining resilient. Now let's zoom in on Ford, the blue oval, and how they're reacting within this market shift. In Q1 of 2025, total U.S. sales edged down 1.3% to around 500,000 units. This according to FordAuthority.com and DailyRevs.com. Trucks were up 15%. F-Series and Rangers moved serious volume. Hybrids jumped 33%. EVs grew 11.5%. Overall sales dipped due to weak SUV and car performance, but electrified and truck segments are bucking the trend. They also took a massive financial hit, an $800 million tariff blow in Q2, on track for $3 billion in 2025. Profits have tumbled. Ford executives withdrew annual guidance after a 65% Q1 earnings drop. So Ford is responding by doubling down on U.S. manufacturing, electrified trucks, and efficiency. Here's how Ford stacks up with its major rivals. Toyota is wrestling with a 16% profit decline hit by tariffs and rising costs. GM swallowed a $1.1 billion tariff charge, pushing earnings down 35%, but they're still buffering price hikes for customers. Honda suffered Q1 operating profit costs of nearly 50%, losing $1.66 billion. Nissan, a staggering 90% drop in profits. Ford's investments in EV platforms, U.S. builds, and lean manufacturing feels proactive, while others appear defensive or in scramble mode. For consumers like yourself, here's how to play this out. Watch early EV and hybrid promotions, especially with Ford pushing at $30,000 for the midsize EV truck. Inventory is loosening in some segments, especially sedans and luxury models, so be ready to negotiate there. Use market data tools to track price movements and leverage the trends. So I saw this headline stating why dealership employees are quitting in droves, and I thought, clickbait, right? But then I dug into the numbers, and honestly, it's worse than I expected. The turnover rates are insane. Sales staff disappearing faster than the cars they're trying to sell. And the fallout is not just a headache for dealerships, it's something every car buyer should care about. Here's the raw data. Overall dealership turnover is sitting at 46%, which is nearly double the national average for other industries. For sales consultants, it's even worse, 67% turnover, meaning 2 out of every 3 salespeople won't be there next year. They're averaging 2 to 3 months before they quit. That's not just an HR nightmare, it's expensive. Industry studies show that each departing salesperson can cost a dealership around $45,000 in lost sales, hiring, and training costs. For the average store, annual turnover can bleed over $440,000 straight out of the bottom line. And remember, this isn't an isolated thing. These numbers have been climbing steadily for the past 3 years, with 2024 hitting the highest turnover rates since before the pandemic. When asked why they're walking away, the same theme keeps coming up. Pay and compensation frustrations. It's not always about low pay, but unpredictable pay. Commission-based jobs mean income swings wildly, month to month. Add in favoritism, pay disputes, or technicians feeling undervalued compared to sales, and as a recipe for frustration. Toxic workplace culture. Nearly half of departing employees cite bad management, constant negativity, or a lack of respect as their final straw. When leadership doesn't have the staff's back, people start looking for the exit. Next, no clear career path, especially for younger employees. Dealerships often fail to show a path for advancement. Without promotions or training, they say they feel stuck. And work-life imbalance. Long hours, working weekends, and the stress of meeting quotas takes its toll, especially when other industries now offer better pay, better hours, and less stress. The reality, in today's job market, good employees can walk away and they know it. When turnover gets this high, it doesn't just hurt the balance sheet, it hurts the customer experience. Training gaps mean less product knowledge, longer wait times, and more mistakes. Relationships vanish when your trusted salesperson hits the road. That personal connection, the one that keeps you coming back, is broken. And here's the kicker. High turnover can also lead to desperate sales tactics, because when people are worried about hitting their quotas before quitting or being fired, they might push harder than you'd like. That can create a pushy, unpleasant buying experience. It sounds like some dealers are taking this seriously. They're rolling out benefits like birthday PTO, better health coverage, profit sharing, paid training programs, even mental health support. A few are restructuring pay plans to reduce the wild swings in commission-based income. Others are investing in onboarding and mentoring programs so those new hires feel supported from day one. Those strategies can work, but they require commitment. The problem is, turnover is still trending upward, meaning the fixes so far haven't solved the root causes, like updated pay structures, toxic management styles, and the grind of high-pressure sales environments. For you as a car buyer, this matters for two big reasons. Number one, service quality. A dealership constantly replacing staff can't maintain consistent service standards. One month you might get a knowledgeable, helpful salesperson. The next month you're dealing with some brand new and undertrained person. And number two, negotiating leverage. High turnover could mean more willingness to make a deal because a struggling dealership wants to move cars, but if the staff is inexperienced, you might not get accurate information or the best buying process. The dealerships that figure out how to keep their best people will ultimately win on customer trust. And in this market, trust is everything. So yes, it turns out employees at car dealerships are quitting in droves. And it's a symptom of a bigger problem. Dealerships caught between old school sales models and a rapidly changing car market. Quote, the biggest car repo crisis in US history explodes. What would you think if you read that? My first reaction was, what? The biggest in US history? Bigger than 2008? Bigger than the credit collapse that nearly took down the entire auto industry? If that's true, we've got a problem way bigger than just car loans. So naturally, I dug in. I went through the data, industry reports, and news sources because, let's face it, we all know YouTube thrives on drama. And in this video, I'm going to cut through the hype and tell you what's actually happening with car repossessions in America right now. Spoiler alert, the numbers are bad, but the full story is more complicated, so stick with me here. So the headline makes it sound like we're in an unprecedented disaster. Millions of cars being yanked from driveways overnight, financial collapse, and the end of affordable transportation as we know it. Here's the narrative. Loan defaults are skyrocketing. Americans can't keep up with record high car payments. Repos are hitting levels never seen before. That's the exploding crisis angle, but is it really the biggest in history? That's where things get a little murky. Here's what I found after digging through Bloomberg, Cox Automotive, and industry analysts. Delinquencies, yes, they're up, way up. Roughly 6.5% of subprime borrowers are now 60 plus days late on payments. That's the highest level in over 30 years. Repos are surging. In 2024 alone, about 1.7 million vehicles were repoed. That's a 43% jump in just 2 years. That puts us right back near the levels we saw after the 2008 financial crisis. This is where the working class borrowers get hit the hardest. Subprime loans, often with sky-high interest rates and long terms, are fueling a lot of this pain. Now here's the nuance. Some experts point out that while repos are climbing fast, the overall rate of repos is still in line with long-term averages. In other words, yes, it's serious, but not quite the apocalypse the headline suggests. So when someone says this is the biggest repo crisis in history, technically, no. But it is one of the worst spikes we've seen in decades. Absolutely, yes. Let's talk now about why this is happening. Number one, record high car prices. The average new vehicle sells for nearly 50 grand. EVs are pushing 62 grand. That means higher loans and bigger monthly payments. Number two, longer loan terms. 72, 84, even 96-month loans have become commonplace. They make the monthly payment look affordable, but they keep buyers underwater for years. And number three, negative equity. People trading cars before paying them off are rolling thousands of dollars of debt into the next loan. And number four, high interest rates. Financing costs have doubled since 2021, making those already high payments even tougher to afford. Putting all this together, you've got a system that's prime for defaults. When the economy tightens, borrowers living on the edge get squeezed and repos rise. So let's go ahead and cut through it. Yes, we are in a very real repossession surge with numbers not seen since the Great Recession. No, it's not officially the biggest repo crisis in history. That is YouTube sensationalism. The truth, this is a wake-up call for car buyers. The system is stacked against anyone stretching too far to buy a car they really can't afford. So please, before you sign a 7-year loan just to get the car you want, understand the risks. This repo trend shows exactly what happens when too many people buy more vehicle than they can truly handle. And here's where I'm going to help you out right now. If you're in the market right now, whether it's new or used, the best defense against becoming part of the repo statistics is knowing what dealers actually pay for these cars. So don't get trapped in inflated prices or sketchy financing. Visit quotes.everymandriver.com. It's a free tool where you can see real-time dealer invoice pricing, not just the retail sticker. Thousands of people use this every day. They avoid overpaying, and it could save you hundreds, possibly thousands of dollars on your next car. It's all based on your zip code. If you don't find what you're looking for in your zip code, change the zip code, be willing to travel outside your area, and you can save money on your next new or used car, truck, or SUV. Because let's face it, the auto industry isn't going to warn you about the dangers of negative equity or repossessions, but I will. So, biggest crisis in history? Nope. Serious problem? Yes. And the smart move is to protect yourself before you end up in the wrong side of this trend. I'm Dave Erickson with Everyman Driver. Thank you for watching. Subscribe. I'll see you in the next one. You can save $50 right now on the Nuvio Recovery Chiller. It works with any tub, bathtub, cold tub, indoors or out. Just plug it in, set the temperature, and start plunging. Use my code below and grab your deal today. One final note, if you are in the market for a new vehicle soon, great. Connect with your local dealership and price and test drive at least 3 different vehicles. A vehicle's strengths and weaknesses can only be discovered when you are behind the wheel. My reviews can be good, but you need to test drive these yourself. Visit quotes.everymandriver.com, select the make, model, and your zip code, and you'll get invoice pricing in your area on those vehicles. Shop smarter with price quotes at quotes.everymandriver.com. Looking for a great at-home sauna at a great price? Get 5% off any indoor or outdoor sauna, cold plunge, or infrared sauna from Almost Heaven with my discount code DAVE, 5% off at checkout. For over 40 years, Almost Heaven saunas have been trusted as the top American home sauna manufacturer. Almost Heaven saunas deliver high-quality products and firmly stands behind the holistic benefits the sauna brings to your mind and your body. Again, get 5% off any order with my discount code DAVE, 5% off at almostheaven.com. There's also a direct link below this video.